Such a privilege to have you here on the show, Mr. Damani.
Abba, thank you so much. It's always fun to be on with you.
Well, fantastic, and so many new things to discuss with you today.
Absolutely.
You know, we want to hear the story, Mr. Damani, that everyone hasn't heard yet. The story about how you began. What were your early days like, when you started to test the waters and explore the stock market?
Abba, it's a great question and it's an interesting story, so I'll share it with your viewers. I was a student in America and then I started working as a techie in America, one of the early wave of Indian techies working there.
First of all, I never knew you were a techie.
Yeah, I was, believe it or not.
A revelation,
yes, absolutely. Hardcore techie in the sense that we see today.
Yeah.
And then my father was always in the investment market. In the late 80s, had kind of premonition that India was on the takeoff stage, that economic reforms would begin. And being the only son, he used moral persuasion to bring me back to India. And I became a member of the Bombay Stock Exchange.
Okay.
But before that, how he got me interested in the stock market was at some point he had given up interest that I would stay in technology and not get into stocks. And he sent me, when I was a student in America, the princely sum at that time of $10,000 US. He says,
that's quite a bit.
In the India of the 1980s, that was a princely sum. And he said, here's the condition that it comes with. Invest in the stock market. If you double it, it's yours to keep. If you lose it, no questions asked. Only thing you have to invest in the stock market. And within 6 months, Abba, I had lost that entire money.
Oh my God, you'd actually lost it.
And what the tragedy was not that I lost it. The tragedy was that a bull market had begun in America. And for the life of me, I couldn't understand how he could be so stupid. An MBA student losing $10,000 in a bull market. And the moral of the story was that I was investing looking at the rear view mirror. I was buying the stocks that had worked in the previous bull market because they had fallen so much. Oh, the gold stocks were down 70%, the oil stock was down 80%. So I thought they represented bargains. It was an expensive lesson in terms of money, but in retrospect, it was a very cheap lesson to learn.
What was your father's reaction?
He was true to his word. He was true to his word. He said, he understood. He was in the market for the last 2 decades or 3 decades, and he understood that losing money is a part of this business, and that frustration, it turned out to be the easiest $10,000 I lost because it helped me a lot. I'll tell you an instance when Steve Jobs, whom a lot of people admire, talks about connecting the dots in your life, that he was a calligraphy student when he was in college. That's the only class he took. And 30 years later, when he founded Apple, all those beautiful fonts that were in Apple system came from his calligraphy background. So the lessons I learned during my phase as a analyst, for example, in the market, helped me immensely in the next 30 years of my career. So there are no mistakes made. There were only lessons learned.
Fantastic. And they're founding stones, really, as you said.
They were, actually, in my case, they were, yes.
So, did it also kind of hook you onto the markets, or did you have that kind of desire to sort of get back in, make back your money? I mean, what kept you going? I mean, because you could have sat back and said to your father, you know what, I tried it, it didn't work.
Any guy with a, a normal IQ will get frustrated by losing money when the markets, I could see the Dow Jones making new highs every day, and here my portfolio was making new lows, and that's frustration. And that frustration sometimes leads to excellence. It started me to read a lot. I used to read a tremendous amount. And when I came back to 89, 90, there was a huge boom going on. The so-called Harshad Mehta bull market was going on. So I got wrapped up into the fever. But the story was I didn't start really investing until maybe 5 years later when the Infosys IPO came out. First few years I learned the rope, watched the people, did money as a brokerage, tried to build my capital. It's only until 92, 93, after the bubble had burst of the Harshad Mehta, that I actually thought of myself that rather than make that 1% you make as a broker, let me make the 100% that some of my smarter clients were making by investing in stocks.
So you, as you said, you got in actually when the markets were on a down cycle or had actually, gone through that bust.
It went up to 4,500 and then was starting to correct very seriously. Yes.
So again, I mean, there's so many young investors today who are afraid to get into markets after a bust. They're always worried it's going to go lower or that there's no money to be made now for some time. What's the thinking there, Mr. Damani? How do you kind of, it's probably the best time to get in with a longer term perspective, but how do you kind of rationalize that to yourself?
There are two great lessons from your question. The first lesson is what I alluded to earlier of connecting the dots. I was a techie in my years in America, in India. So because of my background, it was very easy for me to understand the value that Infosys brought to their clients, so the Wipro, the quality of work they did and the value they offered to their customer. So I was one of the first few people who were lucky enough to invest in those companies, and those paid off very handsomely. So for young people, the lesson is have a circle of competence. There are 5,000 stocks that trade on any given day on the Bombay Stock Exchange. Try and find a sector that you're competitive in. If you're a banker, look at banking stocks. If you're a medical practitioner, look at stocks in the pharmaceutical world. Find early a sector that you love and try and invest in those rather than mimic people in other sectors which you have no idea about.
And that's just it. I want to ask you that because a lot of the contestants that we're speaking to on the show, they seem to all be following the momentum. They track the news, that they look at stocks that everyone's buying or are rising in an otherwise positive market. Is that the wisest strategy to follow, or is that okay as long as you're also complementing it with perhaps other things?
Well, there are two thoughts on that. If you are, say, a fashion designer and you have, or an anchor like yourself, and you have no idea about or time necessarily to devote to the stock market, Warren Buffett always says buy an index fund that tracks the index. What that means is that if you feel particularly bullish on the country, buy the Sensex stocks or buy a fund that tracks the Sensex, and don't do anything about it. It's a very easy one decision investment. Nothing else to be done about it. But those of you who are fascinated by money and want to make it big, the first thing to remember that superior investment comes from thinking differently. So if you follow the momentum, if you follow the crowd, it's unlikely to make you big bucks. So the idea is to always use your thinking cap to come out with, different ideas. For example, one of my friends whom I admire tremendously, and it's a live example, so it will resonate with your viewers. When my son was 13 or 14 years old, we have a small ceremony to name, for the official naming. And I think maybe we had 200 guests, and all the guests gave him clothes, toys, cash, sweets, what have you, including his parents. One wise friend of mine gave him a 50,000 rupee gift, but that was in stocks. And the stocks, I'm happy to report, is still in his portfolio today, and that 50,000 has become 50 lakhs in a period of 20 years. That is the power.
Amazing.
The lesson in that, Abba, is the share, by the way, for those who would want to know, was HDFC Bank. So the stock is compounded, the dividends are worth probably 50,000 today, 20 years later. Now think about it, 200 people gave gifts to a child and all the gifts are forgotten and disposed of. No one remembers that. This is an everlasting gift that the friend has given. That's the power of a stock. The principle this is here, that when you are young in life, all right, you need to invest in assets that appreciate, not depreciate. For example, you get your first job, you go buy out a car, take an expensive vacation, buy a designer dress. Likely in 2 years, they're all going to depreciate. Nothing wrong with it, but you're not going to help you build your fortune. But you invest in good quality companies, great quality businesses, they're going to appreciate a period of time. At the end of 5, 10, 15-year periods, you'll be far off ahead. The joy of that vacation may have worn off, but the beauty of the wealth you've created, remains with you for a long period of time. So when you're young, the lesson is invest in appreciating assets, not depreciating assets.
Okay, so don't be scared, get in there, work on it, build yourself a security basket as such that allows you to perhaps go even further, delve deeper into the market. So Mr. Damani, if you could share with us what were some of the other principles that you followed or the valuable lessons that you learned in the early years?
But there are many, and if I'm a successful investor, it's because I've stood on the shoulders of many of the greats, learning from, say, the Warren Buffetts and the Mungers in America, and also the greats that we have in the Indian market. But the one principle that I found that has helped me, it liberated me financially once I learned it, is the principle of compounding. Albert Einstein called it the eighth wonder of the world, and it really is in matters of finance. Let me give you a simple example. People always say that, oh, how do I get rich? How do I become like you? Whatever in this business. And I say, even if you have 10 lakhs to start with, all right? You can end up by 25 years later with 25 crores. How do you take 10 lakhs and turn into 25 crores? The magic, the secret sauce is compounding. And this is how it works. Suppose you are onto a good investment. The investment should double broadly every 3 years. So if you take 10 lakhs, it becomes 20, 20 becomes 40 at the end of 6 years, 40 becomes 80 at the end of 9 years. So if you 8 turns, 24 years, the 10 lakhs doubling every 3 years becomes staggering amount of 25 crores. And the secret of that is compounding. So if you want to follow that, here are the two principles you need to remember. The earlier you start, the richer you'll be. Right? So you want to start young. So come back to the old point. Invest in appreciating assets, not depreciating assets first. And then think long term. There are a lot of businesses that are, built for, the next 5 years, 10 years that are not threatened by technology. Say, for example, food companies, FMCG companies. So there is a thought process that has to be involved in that. a lot of your viewers, for example, are more excited by trading,
Yes.
for example.
Yes.
And Mao Zedong was chairman of a communist country, ironically said that power is never given, it's taken.
Right.
If you're a good trader, you'll know about it. You don't need my permission to go and trade. You'll know about it.
Yeah.
But 98% of the people are not good traders, all right? But they still enjoy it a little bit. You
Yeah,
enjoy going to the
exactly.
races, having a little fun. So what I would suggest to them is have two accounts. One is the serious investment account where they keep 90% of the money. 10% is a trading account where they can trade for their tips, they can trade for their fun. You know, people enjoy that. It's a vicarious pleasure. I'd be wrong to say I don't do it. Even I do it. But I know where my serious money is. I know where my wealth has been made. My wealth has been made in investing. And the trick to doing that, there's nothing. Imagine with 10 lakh rupees, you can move up to 25 crores in a period of, say, 25 years. That will make you the richest percentile of Indians in the world. Is just finding great businesses. So the effort should always be to find great businesses, stay patient with them. Rome was not won in a day. You will not become wealthy in a day. But over 25 years, this is probably the best recipe I have to become wealthy.
And it's a very valuable lesson at that.
Thank you.
Mr. Damani, do you think things have evolved today to a point where information about some of these companies is more widely accessible? Do you feel that retail investors, and thanks to technology as well, across the country are being able to get into the markets with a little bit more knowledge and ease than they had perhaps earlier?
It is. I mean, you look at India, for example. It used to be when I started a physical outcry system. You had physical shares. On a busy, busy day at the Bombay Stock Exchange, you would do $100 million worth of trade. You can do now $10 billion worth of trade. And the same information is available at the same time across this great country. You know, the question, Abba, I get asked by a lot of young people is, oh, you were lucky, you know, you got in at when the index was, say, 700. It's 30,000, and so it's very nice for you to sit back and tell us, pontificate on what is. And this is not me, with all the investors I associate with the bottom of our heart, we tell you this, and because you're young, you deserve the truth from us, that the opportunities in India of 2017 and in the next 20 years are greater than they were in the last 20 years. All right, you just have to have that mindset to think of value. They may not be in the conventional stocks. When we came in, for example, the old stocks, Bombay Dyeing, Baroda Rayon, Grasim, all had become obsolete. A new generation of stocks rose up, Infosys, Wipro, TCS, right? And we took advantage of those stocks. There'll be a new generation, Google, Facebook in America, maybe electric car makers, Tesla, I don't know. There'll be a whole bunch of new investor ideas. So you have new thought process. You can't say, oh, I want to make 10 times my money in, say, Infosys or TCS. You're probably not going to do that. But there are lots and lots of companies. Capitalism is more widespread. Entrepreneurship is more widespread. And there are more people wanting to create multi-billion dollar businesses. So I think there'll be tremendous opportunities. So that's no fear.
Okay, so you mentioned international markets. What's the best way to get into international markets? We have a bit of a debate on our show this week where some of our contestants are very big on investing on the NYSE and NASDAQ, and some of the others are staying away completely, saying that they just don't want to dabble in something they don't understand.
Yeah, you know, it's not for the faint-hearted, but it's quite rewarding. Because I do a little bit myself, international investing, because you know, I read a lot and I find good companies, and value investing is value investing. If it was different in India and different in North America, the principles would be the same. But Buffett, Graham have taught us for many, many years that what is the key to value investing? You want to buy a rupee worth of stuff at 50 paisa. You want to buy things cheap. And you can get it in so many ways, in so many different franchises. So if you're sharp, inquisitive, and now because we can send a significant amount of money overseas every year, $250,000, you know, it's a great place to test yourself against the best in the world. So you know, if someone is sharp and has the money to afford it, I think it's okay.
And in an increasingly globalized world, why not?
That's the latter part. That you know, if you want to bet on, say you're very bullish, your insight is that driverless electric car is the future. You pretty much don't have much choices here. You need to go to invest in, say, Sweden or you know, America or maybe even Korea. So, you know, then you need to think globally. If your hypothesis is global, you probably need to invest globally.
Okay, so where are the next opportunities, Mr. Damani, according to you? We must ask you that.
It's a question I'm always engaged with, so I'm happy to answer that. I think globally, if you ask me, there's a lot of fear that World War III will start with nuclear weapons, right? Because But the fact of the matter is there may be only 10 countries or 8 countries that have access to nuclear weapons. And everyone watches each other with like a hawk because they all know the threat. We watch each other with a hawk. There could be some terrorists getting some dirty bombs, but that risk aside, I think the risk of the future is cybersecurity. Every country has a laptop, a PC, and internet connection, and they can launch a virus from everywhere. The chairman of the CIA group of cyber terrorism was asked what he felt, and he said there'll be 2 kinds of companies in the world: companies that have been hacked and companies that are going to be hacked. So there's a huge threat to that. So I think companies that help you solve this problem, maintain your privacy, maintain your data integrity, maintain your uptimes, I think will tend to do very well. So the first sector I look at is cybersecurity. Coming more, there are some themes domestically you can play on that too. Some companies you can play on that. But if you want to look at some other sectors, which I've been recently looking at, there has been a huge upsurge in gaming or casino activity across Asia. You might have noticed in the press, Japan is about to start a casino. Cambodia has it, Philippines has it, Malaysia has it, Singapore has it. I think if India wants to become a tourist destination, and that Mr. Modi has promised to make it a tourist destination, I think we pretty much have to liberalize our views on gaming, gambling industry. So I think there'll be a big upsurge. These are very valuable companies because they have a lot of free cash flow, great margins, repeat businesses. So, and there are not too many choices, but I think broadly that's a unconventional sector to look at. The conventional sectors do well, pharma, FMCG, but those two are unconventional sectors.
It's again finding that niche opportunity.
Exactly, exactly the point,
No, and our contestants track you very closely, Mr. Damani, because we had a question on cybersecurity, which you've answered already. Vedant was going to ask you about that. I think there's also some interest in what you thought about telecom and all the news there, and if that's something that's on your radar.
It's earlier on the show, I mentioned to you what we call a circle of competence, and telecom has not been one of my circle of competence. So what you're going to get there is a busy tone.
Okay, good one. Okay, Akash Gupta, he's also wanted to ask you, what are the 5 to 6 points to look for when you're trying to identify a multi-bagger?
It's a great question, and I could devote a PhD hypothesis to it. But here are the first few things I look. Here's the trick to finding multi-baggers, is to first find the value of a company. And how do you find the value of a company? Number of shares outstanding times the price. All right, that gives you the market cap of the company. And that's a starting point. So for example, when Infosys went public, this might be hard to believe today, it's a 3 lakh crore market cap company. The market cap of the company was 50 crores. The 3 crore equity, 100 rupee price, so it's basically 30 to 40 crores the market cap of Infosys. Today it pays out dividends worth 4,000 crores probably a year or more. And today it's worth 3 lakh crores. So it's been one outstanding company. I'll give you another example that worked out and tell you how you capture the sense of value. After Infosys, I started looking at the other technology companies out there. And the government had divested some public sector companies. And there's a company that does the Indian railway systems. Anytime you travel, they make the tickets for you. Anytime you trade on the BSE, the software is done by that company. And that company was called CMC. And the government, it was available for 20 rupees at a 15 crore equity, 30 crore market cap. Now here's how your education and other background helps you. I was a techie, right? So I knew the value of that business. I mean, suppose I'd given IBM the contract to make the Indian ticketing railway system. They would charge the government $200 million to do it. And here you're getting this entire company, including the assets, other software for 30 crore rupees, That's value when you see that. Now, if you did the outstanding shares time price, you got the market cap. And you said, I would be happy to buy this company for 500 crores because I'm a techie, I know this business. And here the government is selling me 20 crores. Why not buy this? Because the gap between the intrinsic value of the company and the market value was so enormous. So the first part you have to do is to find the difference between that. If it's in your circle of competence, it becomes far easier to do that. Then you obviously look at the growth prospects of the company. You say, a cheap stock may remain cheap. If you're going to invest in a typewriter business, no matter how cheap it is, it's going to remain cheap. So you have to find a trigger for growth, something that will unearth the growth. We could see, for example, in the media industry, digitization happening. That would trigger huge value. In cybersecurity, we see the huge trend for people trying to protect themselves. So you got to find a trigger for growth. If you marry these two, you're probably okay.
Sorted. Okay, so think big is also the message here.
The trick, if you can conclude with this point, is that you put all these things together. The final lesson in this is that you have to think big. And what I mean is that when a bull market comes, you won't get rich by making $5,000 or $10,000. You'll get happy, maybe have a good night out with your friends.
Yeah.
But the trick is when you find a great stock, when you find this great value and you have this great conviction stock, is to back up your truck and buy a truckload of that stock. Because when that does well, that's when you become seriously rich. So you want to become Warren Buffett, you want to become Rakesh Jhunjhunwala, you want to become whoever is so idealized by the media. You need to be able to back up the truck, bet high on your conviction.
Mr. Damani, thank you so much.